Thank you. It's a pleasure to be here. I'm Sasha Dichter. Um, I'll just quickly introduce myself and then introduce the panel, and then we'll jump in, if that's okay. So relevant to this conversation, we've been working on this question of impact measurement for a long time, and had developed a service that we're calling Lean Data to make it easy for anybody to listen to end customers. And so I can share a little bit more about what that looks like, but it's particularly relevant in early stage when you have end customers. I would offer up there's a big gap in actually high quality data, so we're trying to help direct investors in particular fill that gap. We have a great panel here today. I will start with Hannah. So Hannah is Director of Impact and Responsible Investing at Nuveen. Nuveen is the asset management arm of TIAA, and at Nuveen she's working on impact strategy and measurement across asset classes. Hannah also brings a lot of expertise from her work at the GIN, where she authored a number of papers on business value of impact measurement and this question of how to exit responsibly. So welcome to Hannah. Thank you for being here. Jennifer Signori is Senior Vice President for ESG and Impact Investing at Neuberger Berman. She's responsible for integrating environmental, social, and governance considerations across the platform. She was previously a director at Bridges Fund Management, which is a specialist impact investor, and she helped bring Bridges to the United States. And she's also on the board of the Wharton Private Equity Venture Capital Association and is an advisor to the Impact Management Project, which I think will probably come up to in our discussion. So welcome, Jennifer. Anissa is an investment analyst at Tideman, which is a wealth management firm with about $15 billion in assets, and they have a $2 billion ESG and impact investing portfolio. She's focusing on building out that impact platform, and will tell us a little bit more about that. She joined Tideman from the Threshold Group, which is a multifamily office that specializes also in impact investing, and before that was working in climate change consulting. Welcome. And finally, to my right, Jane Beinman is a senior director at Tideline, which is a consulting firm that works in the impact space and more broadly. She joined Tideline in September 2015, and before that was at UBS and Citigroup, working with private equity firms to help them structure and raise funds. She's also worked as an advisor at Women's World Banking and with Blue Orchard Finance, which is a Swiss impact investment manager that specializes in microfinance. So welcome, it's a great panel. Thank you for all being here. You're all supposed to applaud now. Okay, so we'll start off with some softballs. We'll go from there. So just to level set quickly, if everybody could just, in order, so I guess maybe we can start over this end. How do you describe how you measure impact in your firm? A little bit the questions we asked for the group. How are you doing it, and why?
Yeah, great. So we have, as we mentioned, impact investments in both private and public. This session is supposed to focus on private, so I'll talk a little bit about that first. We have an in-house team that, so speaking to the question of how is it kind of resourced, our investment and kind of portfolio management team also handles impact measurement and kind of, I like the term underwriting the impact, really figuring out if the investments that we're looking at are going to align with our impact strategy. And so we have developed some in-house tools and kind of checklists and frameworks for doing that. And then, it's an evolving practice. I think we've been making the most progress with the affordable housing portfolio in terms of measuring impact and looking at it longitudinally to build insights from that. And I think, am I answering kind of how or also why now? Did you want to?
How would be great.
How? Okay, just how. So yeah, so does that kind of speak to it? I could also mention that we, in terms of kind of tools that we're using, we do align with IRIS metrics, and we have found the impact management framework actually quite helpful for just articulating some of the different aspects or dimensions that we should be thinking about. So those 5 dimensions of impact have been helpful to us as well. Yeah, maybe I'll pause there.
Great. And just for jargon, IRIS is the Impact Reporting and Investing Standards, which is a set of standard definitions of impact. Someone else mentioned GEARS, which is the Global Impact Investing Reporting System. And the Impact Management Project will become the IMP any minute now, so I'm just warning you of that. Yeah. Okay, great.
Hi, Jennifer Signori. So Neuberger Berman, we're a multi-asset class manager across equities, fixed income, and private equity. We manage about $300 billion, of which impact investing is a subset of that. And I think about impact across all of these different asset classes. How we measure the impact, as you can imagine, varies depending on the asset class. The availability of information, for instance, is a big constraint there. But in terms of how we think about it specifically to the private markets, you heard it mentioned this morning, but we're looking for companies where the core business or the products and services are contributing to solutions to pressing social and environmental issues. Often the SDGs or the Sustainable Development Goals we found to be a really helpful framework to define what are those challenges. So we definitely use that as a guide, but by focusing on these these companies where the impact is integral to the core business, the impact metrics that we measure essentially are also business KPIs. And we think that's quite important when you think about, we'll go into this later, but also just why are we measuring for impact? I know clients are asking for it, and that's something we want to be responsive to. It's something that, for our impact investing strategies, we have a very clear impact objective to these strategies that clients are essentially signing up for. So we need that to follow through in the entire investment process. So all the way from the selection of the investments to the portfolio management of them, as well as the reporting. So the measurement piece, I think it's quite obvious that it's a component of reporting, but I think where we want this to head as an industry is that it's actually, there's a feedback loop and that those metrics are being used to help manage the portfolio, given that it's a dual objective that we have in these strategies.
Great. And we can talk about that some more. Perfect.
So can everyone hear me? So I'll start with the why first and then talk about the how. So in terms of why we do impact measurement, I do think that you have to demonstrate that a company is achieving positive impact in order to have confidence that you're going to be successful. And the reason I say that is because a lot of the sectors that we work in, whether it's education, affordable housing, financial inclusion, you have to be a good actor in order to succeed. And this is especially true if you're trying to replace or improve on an incumbent system. So for example, if you are investing in a company that has a new healthcare product or a new education product, that company needs to demonstrate that it is better than the alternatives in order to succeed. So I think that we have every incentive to engage in good impact measurement. Now it's tricky, which is why a lot of people don't do it. It takes a lot of time, it takes a lot of resources, but we have every incentive to do it. So that's sort of an answer in terms of why we do it. In terms of how we do it, I would sort of split it into two phases. So the first phase is pre-investment. So pre-investment, a lot of what we do is we spend time looking at academic literature, trying to identify the type of interventions that we want to support. And then we spend a lot of time thinking about the type of capital that we want to use to support those interventions. So that is pre-investment. It's a lot of forward-looking analysis. Post-investment, we do a lot of backward-looking analysis. So we're tracking basic outputs. In some cases, those are quantitative outputs, like number of affordable housing units built, number of students served, and we're combining that with qualitative outputs, like case studies and survey results. So it is backward-looking. What we haven't done yet, and we're always talking about this, is trying to take those quantitative outputs and translate them into long-term outcomes. And we can talk more about that later. But that's sort of how we think about impact measurement. We think about it pre-investment, where we do a lot of work on theory of change, forward-looking analysis, and then we think about it in terms of post-investment, trying to track those outputs, trying to get a sense of whether or not they reinforce and kind of show progress towards the goals that we set out front.
Perfect. And Jane?
Jane Bieneman with Tideline. As Sasha mentioned, we're a consulting firm, so it's actually our clients who measure the impact, but we help them design and implement the systems and practices to do that. So I thought I could talk about a couple of commonalities in how we see our clients measuring impact at their firms. One kind of, at a high level, what we see with our clients is that they are implementing systems that are fully analogous to those they have for financial management and measurement, and we think that's really at the core of being an impact investor, is that it's central. Impact management and measurement is central. So from sourcing to exit, they're doing something that's analogous to what they're doing from a financial perspective. So if there's a set of criteria that are screened for deals in the pipeline, minimum EBITDA, portfolio company ability to provide accurate and timely reporting, there's going to be a similar set of criteria for impact that they're looking at, and that goes on through through the system. So I guess one observation I'd make is that it's very comprehensive and integrated, the approach to management and measurement. And then at a bit more of a specific level, what we're seeing and working with our clients to do is take an evidence-based approach to measurement. So our clients are looking at the data that connects the activities that they're engaged in to the impact goals that they're setting. So if, for example, it's you've got a healthcare investor putting equity into health centers to expand them to achieve better health outcomes, what is the set of evidence that points to expanded health centers driving better outcomes? Is it lower incidence of disease? Is it better pregnancy outcomes? So we'll actually kind of collect that data and establish measurement and metric systems that tie to that data. And one, we think it's really important to getting to what's meaningful and making sure you're targeting meaningful metrics. And secondly, it's another goal of our clients is always to be efficient and have a light touch, be as light touch as possible, while being robust and rigorous in measurement and impact management. So focusing on an evidence base, we think, help achieve those two goals.
Perfect, great. So one more question for everyone, and then we'll jump into specifics for each of you. But maybe we can go back in this direction with Jane. Can you talk a little, I'd like everyone just, sorry, the question is for everyone, but can you talk a little bit about investor expectations? And in particular, how is intentionality around impact manifesting for investors? So I think it's one thing to say impact would be a good thing, and another thing is to be intentional about it, and you were sort of alluding to some of that. So what does intentionality look like now versus maybe 5 years ago?
Yeah, so what we see is that intentionality varies a lot across the spectrum of investors. It goes from, very specific about intentionality with, for example, philanthropic investors, so an MRI program or a PRI program is going to be, highly specific. And at the other end, there's very general expectations. I want to do good. And as I think more and more individual investors come in and more institutional investors, but who are less familiar, there's going to be more general intentionality. Where it is more specific, it frequently is manifested in either kind of impact themes. So I care about the environment, similar to the questions we asked at the beginning about sectors, but it manifests in impact themes. So I care about the environment or education or increased access to good housing, or it's place-based. So I care about impact, in my community or in this area. So where we see intentionality, it's often around either an impact theme or a place, but often there is a need, I think, for a fund manager to help investors articulate what their impact goals are and kind of define intentionality as part of the process.
I think your first question was, what are client expectations and kind of how does that work in practice? So in terms of expectations, I think our clients expect that their assets are going to be managed in a way that aligns with their values and their goals. And it's hard to have confidence that that's going to happen without intent. So it is a very important concept. In practice, it's tricky because it's really vague. So it's very common for us to see fund managers come to us where it sounds like they have a lot of intentionality in terms of what they say, and then when you actually break down the process in terms of how are they making decisions, what actually winds up in their portfolios, the intentionality begins to break down. So we spend a lot of time in the due diligence process looking less at the intentionality of what they say, more at the intentionality of what they do. And we see that divergence less so on the private side, so thematic investments, place-based investments. It's very common for us to find fund managers where the two are aligned. Where we see the most divergence now is on the public side, so in the public markets. So a good example is recently we looked at two bond managers. So one bond manager, well-known fixed income manager in the ESG space. They've been in the ESG space for 10 years. They have a very well thought out ESG ranking system. It includes things like carbon risk, inclusion, diversity, education quality, all the things that you want to see as an impact investor. But then when you actually look at their investment process, it turns out that there is a 98% overlap between their ESG product and their non-ESG product. It really doesn't influence what they do in any way. So they're tracking all the right metrics, but it's not really changing what they do. Now compare that to another fund manager that we looked at, another bond manager. They've never heard of impact investing. They don't know what it is. They are entirely profit driven, but what they do is they invest in nonprofits in underserved parts of the U.S., mostly focused on education, healthcare, senior living. They're providing interest rates that are comparable to CDFIs. They are patient investors. They work with their clients to deleverage the balance sheet, access cheaper forms of capital by getting a credit rating. So they're patient capital. They look and do the way an impact investor would do, but they don't know what impact investing is. So that's a good example of we really try to look at the intentionality of the business model. They work like that because they think it's a part of good credit underwriting. So we look at what you do, we look at what the investment process looks like, how you make decisions. We don't pay as much attention to what a fund manager says.
That's like such a great story. Can I just show of hands for people who are seeing impact strategies play out? Is this example we just heard of it all looks good, but it's 98% overlap? How many people would say that's actually my reality day to day, and how many people would say no, that's actually not? So yes, that's reality. 98%. I know wait, you don't want to admit, but not 98%.
It was 98% a while ago. It's a little better now.
Okay. So, I saw a lot of not show of hands, so we'll see what that, not really sure what that means. Okay, please go ahead.
So the way I'm going to answer this question, I think segues nicely with the story you just gave. So the way we think about ESG, impact, sustainability, lots of terms that are being thrown around, is that there is a spectrum of how one can integrate environmental, social, governance factors within an investment process. So it can range from what we call ESG integrated, so looking at the material, environmental, social factors for a given company that's specific for that industry, and folding in those factors into the investment valuation, into the relative value assessment, to the DCF model, for instance. These are factors that are folded into the decision making, and essentially the price that is needed to justify perhaps the additional ESG risk that's identified. You may find strategies that are labeled ESG, they may just perhaps stop there, where they're saying, we're incorporating ESG, we're using ESG data, we're incorporating it into our buy decisions, but we can buy whatever we want. That definitely does exist out there as an option, and there are some clients that just want that. They want their managers to look at the financially material ESG factors when making investment decisions. There are clients that want to go further, right? They want to amplify environmental, social characteristics of their investments, what we call sustainable investments that have more of a tilt towards what we call best-in-class ESG. They may be, more thematic in nature. These are, clients that are a bit more intentional about what they expect to see out of, the investment strategies that they are purchasing. And then a step further is, impact investing, where we, these are strategies where there's a very explicit dual objective to achieve positive outcomes for people on the planet, addressing pressing issues alongside competitive financial returns. So depending on the investment strategy, I think it's about being very clear within a given investment value chain. If you're an investor signing up for a particular strategy, knowing exactly what flavor of that spectrum you're getting, so that there isn't, the perhaps mismatch or, the, under achievement, because essentially what's happening is that there's a mismatch in the expectations or the communication that's happening, which projects like the Impact Management Project are helping with that streamlining of definitions and norms and et cetera. But essentially that enables, investors to understand, match the intentionality with the strategies that they're getting. So for the sustainable and the impact strategies, we see more intentionality around what the investors expect. And then every company has an impact, right, via its activities, as it relates to different stakeholders, whether it's employees, the environment, customers, et cetera. But for some of these strategies that may not be explicitly, targeting these outcomes, that intentionality is not captured and it's not being measured and reported back to those investors.
Yeah. So I think where we're seeing the intentionality and those kind of expectations around demonstrating your commitment to the intention, manifesting, there's sort of three parts of the investment life cycle, let's say, where you could look at this. A theory of change, which we've talked about, backed up by really strong logic that's evidence-based. So I think we've done a lot of work there, just kind of proof points that let us know that the theory of change makes sense. So intentionality around that. But then once you've selected an investment for that, management of the investment and of a portfolio, really. So how you are updating your hypotheses or your theses as you're integrating new learnings from what you're seeing. And then the transparency and reporting. And I think that's where we actually can do a lot to show to clients, stakeholders, investors that, to really show them what the money is doing. So, we've made the investments, what are the outcomes or results? And I think at that stage, there's a lot of demonstration effect that can happen there, too, to show how the intentionality has then played out through this process. So, of course, the specifics of that will look a little bit different depending on the investment or the asset class, but typically those are kind of the three areas where we would see an intentionality manifesting.
So now just shifting over to more, so Jane, in terms of the kinds of clients that you guys are working with, so two questions. One is, I would expect that 10 years ago or 5 years ago, it comes from folks who are quite intentional, quite deep into this space. And I'm just wondering, are you seeing a shift to more mainstream demand? And if so, what does that look like?
Yeah, so more mainstream demand among investors.
I would imagine that there's a group of folks who have been deep into impact for 10 or 20 years, and then there's Neuberger or larger multi-asset firms that are, clearly there's a move towards more mainstream folks coming to the space. And I'm just curious if you see that reflecting. And if so, when a more mainstream client comes, what kind of questions are they asking, and how do they differ from what you've seen in the past?
Yeah, well, I think, we are seeing quite a bit more interest from mainstream investors. I think one of the areas where we're focusing on because of that is around impact management and measurement, which is increasingly being seen as a solution to the confusion that's out there in impact investing, which I'd say is a main stumbling block today.
Can you describe the confusion?
Yeah, it's what is an impact investment? What impact can be achieved? Am I sacrificing return? What are the goals? And it was interesting to me on the plenary this morning. One of the panelists said the big stumbling block, to paraphrase, and it was product. That we need to get more product into the market, and certainly. We hear that from our clients. We need more product. There still is a focus on more product, but we're seeing a shift away from kind of focusing on product to kind of solving the accessibility of impact by clearing up a lot of the confusion, and there's a lot of focus on doing that. But I guess as a case in point, there's a recent UBS study that many of you may have seen where they surveyed an enormous group of their private clients and asked them questions about what their impressions and impediments for impact investing were. I think 72% said they were confused about impact investing. A similar percentage of the non-adopters said unknown impact was their main impediment. So I think specifically kind of not knowing what impact is. So among, particularly I think wealth managers and intermediaries, there's a real focus, and this is a fairly recent shift towards getting common language, getting practices in place to really clarify what the opportunities are and how you match those with what investors are looking for. So that's one thing we're seeing quite a bit of.
Great. And Jennifer, maybe you can tell us a little bit about the Impact Management Project. It was designed, I think, specifically to address this kind of confusion. on our, once Clara Barbie, who helped create the impact management project. We were in a room, I think it was at Bain Capital, no, it was BlackRock. And at that point, what they were describing was, let's just make the entry point easier. Let's just make it possible for a whole bunch of different asset managers to say, okay, well, I'm here, I'm here, I'm here. And I'm just wondering sort of what problem, could you just explain at a high level what the impact management project is? And do you feel like it is beginning to address some of that confusion?
So my former colleague Olivia Prentice is in the audience. You'll hear from her later this afternoon.
Hiding behind a column, no less.
But while I was at Bridges, one of the projects I worked on was helping to develop this impact management project, which we've referenced a couple of times now, so it is worth defining what exactly is it. So it's an industry collaboration with over 2,000 practitioners, so asset owners, managers, companies, entrepreneurs, to address this confusion along a given investment value chain that I referred to earlier, and lots of different labels being thrown around. So what this project has helped to do over the last year and a half or so is to develop a set of norms or consensus around, what do we mean when we say impact? And, definitionally, as well as what are the dimensions of impact or the questions that one should ask when assessing a particular investment's impact. So looking at things like what outcomes are being derived through the company's products and services and practices, the scale, how much impact is being generated, who is being affected, so who is the end customer, how in need are they relative to the outcome. I think that is often a component that is maybe glossed over in a lot of greenwashing instances. And then 2 additional dimensions around contribution to impact. Additionality is a term that you hear a lot in this space, but the unique contribution of that company towards that outcome being realized. In other words, if a company didn't exist, would that have occurred anyway? As well as impact risk, so the likelihood that the intended outcome will or will not occur. So these dimensions, I think, have been really helpful to understand the impact of an enterprise that one, through the investment that one is making, but then also looking at the role of the investor. So when I think about our activities on the public markets, while it may be harder to measure specific impact KPIs of the enterprise, as well as the additionality that you have as an investor, there's engagement that we do on the public side in both equities and fixed income, where we can use that scale and that influence to affect change or to lead to better outcomes for the people on planet that we care about as impact investors. So I think that those two, the intersection of those two, the impact of the enterprise, the role of the investor, I think has been a new way, not a new way, but I think a more, I would say, articulate or organized way to look at the impact of an investment, and that you can apply this framework across asset classes. So at Neuberger, I've stayed involved as an advisor, and I'm applying it practically, right, to these new strategies that we're developing as it relates to impact investing, but also trying to embed it in sort of the way that we think about our engagement activities more broadly.
I mean, just a plug. We've also been connected to the project, but I would just say, up until this point, there's just been a lot of very specific work done either in-house or by an advisor kind of at this very first stage. And it just feels like we would shift as a sector tremendously if there could be a common entry point. And then, of course, all that specific work needs to happen, but at least we could be having the same conversation. And it's, Olivia will talk more about this, but it is meant to be simple and approachable, and who, what, how much, risk, so that we don't need to everybody create their own sort of set of 16-box thing. So now, in the opening, it sounded like there was a real push for practicality. So maybe you could tell us a little bit about how does this actually play out in practice, and particularly when you've already alluded to looking at particular potential bond manager. But how does your assessment of impact differ by strategy or by asset class, and how does that play out in practice within your firm?
Sure. And I think this may also get to your question around how do you reduce confusion. People come to us all the time kind of asking what is impact, and one of the things that we found to be helpful is explaining how impact looks different depending on the asset class that you're working within. So, for example, within public assets, so fixed income, public equities, we really approach that from a risk management perspective. So we tend to look for managers who are incorporating environmental, social, governance factors from a risk management perspective. So reducing exposure, long-term exposure to things like climate risk. And what that means for impact measurement is we're really measuring impact risk. So we're looking at a portfolio's exposure to carbon intensity. When we can, we look at water intensity. We look at exposure to companies with controversial practices. So in general, and there are a lot of exceptions to this, but in general, when it comes to public assets, we're really trying to measure impact risk. And I'll walk through some exceptions to that in a second. In contrast, on the private side, the goal is a bit different. So rather than trying to measure and avoid impact risk, we're really trying to measure and target positive impact change. So we're trying to see, what are the long-term outcomes to when you invest in education, affordable housing, financial inclusion, and so on. So earlier on, I walked through kind of our process. So pre-investment, we do a lot of work to identify potential long-term outcomes, really pulling from academic literature. And then post-investment, we spend a lot of time tracking the key metrics that kind of show progress towards those goals. The one thing that we don't do that we are always talking about doing is, so we track basic outputs like number of affordable housing units built. We don't try to project out long-term outcomes like that led to a reduction in recidivism, that led to educational improvements, that led to job attainment, that led to improvements in the early kind of learning environment. So we just don't feel like we have enough data to do that accurately. I know that there are groups working on that, and it's something we're always kind of exploring, but at this stage, I don't feel like we have enough data to do that confidently. So we are tracking outputs, but we're not tracking long-term outcomes. So that hopefully gives you a little bit of clarity in terms of what it looks like on the public side versus the private side. The purpose is really different, and that has helped us in conversations with clients. Now, that said, the most interesting investments are the ones that kind of are exceptions. So for example, on the public side, I said usually it's about risk management. There are exceptions to that. So for example, we work with an environmental hedge fund that invests in very small, micro cap, small cap companies that are more thematic and I think are driving very positive impact. And the way that they're working with them is very positive. So for example, this one manager, they're investing in one company. It's a biologicals company. They have a pipeline of new biological alternatives to like chemical pesticides. So in their IP pipeline, they have an alternative to glyphosate or Roundup. That company was on the verge of bankruptcy. So what this fund manager did was they came in, deleveraged the balance sheet, turned all of their debt to equity, and now that company is no longer on the verge of bankruptcy. There is the possibility that they're going to be able to bring that product to market. So that's in the public sector, but I think it's a good example of a high impact, positive change. So those are kind of how we bucket things, but there are always going to be exceptions.
Great. I want to get to Hannah, but just Jennifer, just from where you're sitting in Neuberger, is there anything you want to add or differ in terms of looking at multiple assets and how it plays out for you guys?
I won't add at the moment. I think she covered a lot.
Okay.
I'll come back to it.
Okay, great. So Hannah, then over to you. You've actually just recently shifted over from the GIN to your current role. And I'm wondering, what's the biggest surprise been from being kind of an observer of the space and kind of writing about and analyzing to actually coming in-house and seeing, what does it look like practically day to day?
Yeah. Well, so maybe to tie it a little bit to this conversation and to Anissa's really thoughtful, interesting comments about public and private markets, one of the interesting things for me has been the opportunity that I have seen in public markets. I mean, I think maybe just to be completely honest, I come at that with a little bit of skepticism just by nature. But what I've seen is actually, yes, there is the sort of, I mean, not to confuse a lot of terms, but there are positive results from ESG type activities that you can do in public markets. I think another interesting thing for us has been we have a social choice bond fund, and so that's where a portion of the assets in that fund are actually selected intentionally according to an impact framework. So this is use of proceeds of these bonds going to particular impact themes like affordable housing, community and economic development, renewable energy, and natural resources. And so the opportunity to really to drive change through that, as well as through something that Jennifer mentioned on the engagement side, The opportunity to dialogue with public companies about how these environmental and social issues, to kind of push them to go a little bit beyond their CSR report, a little bit beyond, hopefully a lot beyond their kind of lip service to the idea of being a responsible company, into what that really means. There's ESG branding all over tons of reports now. And we're starting to think about, could we do something? Could we think through what we've seen as best practice in terms of companies that are actually contributing to solving the SDGs? And so there can be a standard instead of sort of an SDG washing, let's say. And so, I think that's maybe sort of one of the things I've seen is the opportunity for impact in different asset classes. Of course, our private market side is pretty well developed on affordable housing and financial inclusion, inclusive growth, and energy efficiency and that sort of thing as well. The other thing I would say is just in terms of the impact measurement conversation, how much need and interest there is in impact information, I'll call it, like sort of data about results relating to social and environmental outcomes, from so many different stakeholders within a very large organization. So I've been just talking to people that I might not have thought were curious about this stuff and gotten into really deep conversations about what is this and how do we know and how can we kind of prove out our theories here. And so, I think within that, there's a need to really thoughtfully balance or include both sophistication and simplicity when talking with different kinds of audiences. And so that's kind of one of the challenges of my job, to kind of keep moving back and forth between the deep stuff, then getting into the weeds with details, and then kind of boiling it down when talking to certain audiences that they really just want to know kind of what does it all mean? What's the so what of it? Those are a couple of the things that, with my shift from kind of the 30,000-foot view of the industry into getting more in the weeds, have been interesting.
Great. Okay, so now I have, for fun, to shift gears, a few popcorn questions. So if you can answer them in like 5 words or fewer, okay. We'll just go quickly through a bunch. So is demand going for impact products going up or down?
Up. Demand is going up, but not as fast as it should.
I think demand is going up really fast.
Demand is going up.
Demand is going up, but are products keeping up? ?
Okay. And who is it coming from?
Can you start with someone else?
Yes. Who's it coming from?
It's coming from the same buckets that were in high net worth foundations. Institutions are slow to grow. Traditional institutional investors are growing slowly.
High net worth clients, as well as smaller family foundations. I think a lot of the larger foundations are already in it.
All of the usual suspects that have just been named, but this is not a popcorn answer, sorry.
We got a popcorn
I've
demand.
been on the road quite a bit speaking with clients as it relates to our private equity impact strategy, and I've been pleasantly surprised by the quote-unquote more mainstream institutional investors showing interest in a product that meets their criteria and goals on the financial side, but also is meeting the increasing demand they're hearing from their own constituents and stakeholders around more sustainable and impactful product. So institutional investors, pension funds, sovereign wealth funds, I think you can add to that mix too.
Yeah, just to add on some endowments we've been seeing since we, we're related to TIAA, and we work with a lot of kind of academic institutions and endowments, so there's a bit of demand there too.
Great. And I think we're supposed to wrap soon, is that right?
How much of the demand that you're seeing has a perspective or a lens on what they want to see, like specifically? Do they want to see a report? Do they want to see evidence? Are they actually asking thoughtful questions when they come to you asking for a product that's impactful?
Okay, let's try to keep it short.
Yeah, it's a mixed bag, but we have some interesting examples where, just we do separately managed accounts also, and one of them has a really specific, like, I want a gender lens municipal bond portfolio. It's an interesting example of a pretty specific impact intention coming from a client.
I would agree. It's also a mixed bag. I think certain clients are further along in their journey of impact investing and they know exactly what they want. I think others that may be newer are kind of looking to us to let them know what we think are considered best practices. But there definitely is an expectation of reporting. I think how frequently is and sort of how deep will evolve over time.
I would say the same. It's a mix. It's hard to tell. We work with clients who know exactly what they want and clients who really look to us to guide them. So it's a mix.
Yeah, I think it's similar to how we talked about the intentionality question. It can range from very specific to less.
Okay, so we have 5 individual questions we need to answer. So everyone, there are 5 of us, so we can each pick one. So just think about what you want. Where are we with the data? What's the most important thing? That's what I wrote down for.
The most important need for future development.
The most important need in the market. What do you do about early stage companies? What do you do with private companies? Connected to not having enough data, and how do we lock in impact? So those are the 5. But I'm going to try once more on popcorn answers, really few words. Biggest risk to the space?
I'll say impact washing.
Okay.
Lack of benchmarking for impact.
Impact washing.
Yeah, I'll just, lack of benchmark or standard to meet. Yep.
Okay. And biggest opportunity?
Changing the world.
Could you think big, please? Okay. Change the world.
I think the influx of demand is really exciting because I think we're going to see a lot of new products doing really different things. There is a risk of impact washing, but we also are going to see some really interesting things come of that. So I actually think that's exciting.
Opportunity?
Scale. So as more institutional investors enter the market, if we can build the infrastructure around the standards to avoid the impact washing, combined with the scale of the capital coming in from institutional investors, I think that combination is the greatest opportunity.
I'll say collaboration. I think it's been a really unique and wonderful feature of this field, this kind of subfield of the financial industry in general, and we should keep that going forward. The risks that we mention are also great opportunities to collaborate, to set standards, and make sure that we can differentiate ourselves.
Great. So now I'll let the panel self-nominate. Where are we with the data? Who wants that question?
I'll try that one.
Yep.
I think we're making enormous strides with the data, and I do think that the SDGs are helping with this tremendously. There's a recent report from the UNPRI that we found super useful that maps impact themes to SDGs to actual KPIs. A client we're working with in impact measurement, we went back to their metrics and kind of tweaked them a bit to conform to this, but it's a really helpful, useful data. So I think that's an example of how we're finding good pathways to have commonality in data and to kind of get very meaningful data in an efficient way.
Could we say the name of the institution that
The PRI, the UN PRI, put out it's a mapping tool.
Great. Who wants to take what is the most important thing to need for future development?
I think it's sharing data. I think is the most important and kind of gets to my point around impact benchmarking. We can't really do that and we can't compare unless people share data. So I think that's important.
Great. I can answer the early stage company one if no one wants it. So I mean, I think I would actually connect to the prior one, probably not for the whole market, but I just think we need to make it easier to get good data. It's so natural, and I can't remember who said it here, gathering impact data is really hard. We're trying to ground it in talking to end customers. That's not going to work at scale for every sort of intervention, but for early stage companies, I think we've made it radically easier to do that. And I think we need to get by our premise that it's going to be hard and heavy and slow. And for the thought I would offer up is, it's really fundamentally about making changes in people's lives. And so if we can understand people better by talking to them, we will understand impact, we will understand who they are as customers, we will add value to companies. So I actually think there's a mindset shift that's possible, but I think there's just a lack of good tools. And it just feels like this giant, heavy, big thing to figure out impact. And I think if we shift to bottoms up, that can change. So that'll be my vote for that answer. So we have 2 left. What to do with private companies. And you work in, I know, a lot of private equity, so maybe, Jennifer, that could be for you. And how do we lock in? Because you wrote an entire report on locking in, so it seems fair.
I was going to tackle the lock-in.
Oh, so you tackle lock-in too.
I
go
can
ahead.
do both.
We can do both.
Time.
But in terms, I'll touch on lock-in impact. I mentioned we look for companies where the impact is integral to the core business model, so the products and services. I think that's really important to do that work up front to identify the companies where that alignment exists. It's harder to strip out the impact once you sell a company when it's imperative for the growth of the business for the impact to also grow. I think what that's also enabled us to do, so we are investing in both companies and funds and partnering with what I would consider funds that have been doing this for a long time, more experience in impact investing, but also partnering with funds that may be newer to the conversation and are kind of looking to us for a bit more guidance around what impact metrics we expect as investors in their funds. So by identifying the companies, whether they're healthcare companies or education companies or clean energy companies, where that impact truly is in lockstep or integral to the business model, it enables us to broaden, I think, the pool of opportunities that we can invest in as a result. And then maybe you can just take the private public.
Yeah, and I'll just add on to that. I think the best case scenario is locking it in where you're sort of like, unless this business completely abandons its business model, there's no way it would stop creating positive impact. So thinking carefully about the business model and how locked in that is. But then, a couple of other things that we found in the report that I worked on at the GIN on responsible exits were the structure and flexibility of the capital itself, so not boxing yourself into a situation where you might be forced to exit in a way that does not, create a good likelihood of positive impact continuing, building in some flexibility around timelines and convertibles and things like that. Another is thinking about who your co-investors are. That's sometimes where pressure for business model shifts or management shifts comes from. And then, the idea of kind of baking it in through the company culture. So this may work also for bigger companies, thinking about their conduct and what they do to sort of govern in a way that the impact and mission is part of everyone's job. And so then the question, what was the last question about? I think that's the one I just...
Yeah, no, there was about private versus public. So I think we covered it.
Yeah, maybe I think we've talked a bit about...
So do we want to do Q&A? Yeah, that's what I was going to suggest. So we tried to cover what we heard from the group, but you can tell us where should we go deeper? What other questions would be good to talk about?
Why don't you take a couple of questions and then...
Sasha, can you talk a little bit about what Acumen does in terms of measurement? Sure. Acumen has been in the business for quite a while, so it would be really helpful.
Yeah, happy.
Thank you.
Hi. Given that impact washing was stated as the greatest risk and the biggest source of demand for impact product is still coming from high net worth individuals and foundations, what are you seeing in the market that's better arming investors to sort of police and make rigorous assessments of GPs' activities around impact? What kinds of initiatives are in play to better educate and arm the investors themselves to do this work?
Anything on this side of the room? Why don't we take a couple more, and then we'll see what we can cover.
So as more data becomes available and used, what are kind of the sources of edge going to be for investors and funds kind of using impact as an investment alpha generative lens?
So everyone talked a little bit about the difference between private and public, but even within those spaces, how are you thinking about the differences in impact within the financial risk spectrum? You're thinking of a newer fund, or you're thinking of a high yield fund versus an investment grade. Where did those variations come into play?
I have a client with a sort of a savings bank alternative or money market alternative for impact program. And when I've talked about it with others, sometimes they're hyper-focused on impact measurement as opposed to impact versus no impact. So how is that a concern, sort of, that we're getting, kind of in the green space, there's kind of this argument that, well, you're not green or I'm greener than, and how do we avoid sort of getting too focused on measuring, whereas it's something positive versus the traditional that's not doing anything, if that makes sense.
So there's a question
So the question is
distinguishing between kind of binary yes, no and kind of impact one-upsmanship?
yes.
Okay.
I don't know
Which
how to-
one are you
it's
worried
kinda-
is good or bad?
I'm worried that I'm walking around with a client that has an amazing product,
Right.
but everyone's so focused on measuring impact
So it might not be good enough. So
that,
you
that
all
they're
of a
not, they're
sudden
not
you're,
able to see
you're
the fact that
talking
it's
about
positive
impact.
versus not at all.
Right. So I maybe rephrase it. It's the moment you say you're creating impact rather than being applauded, maybe. It's like, well, maybe now it's not good enough.
What's the data?
Got it.
Hold on.
Right. I see.
This is actually something positive versus everyone else doing nothing. Interesting.
So we'll take the last one. We're going to weave them all together. It's going to be amazing.
Hello there. In the absence of uniform reporting to date, if the panel could just share amongst the investment managers that they're choosing, what style of reporting are they doing? Are they big reports? Are they data-driven? Like, what do they look like, and what's the periodicity? And then how does that match up with what your investors are expecting and wanting?
Cool. All right. So I'm going to try to bundle these. So I felt like the edge, alpha, and impact and risk question might come together, but maybe my notes weren't close enough. But does someone want to try that one first? Although the person who said the impact risk question, I might have gotten it wrong. I'm sorry.
I'll start with the data bit and the edge. I think as more and more ESG and impact data comes out there and there's more benchmarking, I think that's absolutely necessary to enable us to do this work better and to have these impact strategies be more robust. I think where the edge will come is we still have to do the work, right? Just because the data exists out there doesn't mean that we can just take it off the shelf and plug it in and say, okay, ta-da, we have an impact product now. I think our approach has been very much around fundamental analysis, active management, at least on the public side, and that's what we think is a contributor to that edge. So it's the ability to go deep on our diligence, go on site to factories and sites to really assess what we're looking for when we say we're looking for impact, but also conversely, just broadly speaking, ESG risks that is financially material to that investment. I think that additional work that we think we can do will help provide some of that edge.
Can I give it a shot?
Please.
So I think I can combine sources of edge and differences in impact based on the risk spectrum. So I think the asset classes where it's hardest to differentiate yourself and have an alpha generating edge is in the low risk asset classes. So for example, if you're doing traditional laddered municipal fixed income high quality, it's very difficult to screen things out without potentially having a negative impact. I'm happy to talk about why that is. So low risk assets I think are actually harder to drive, sort of have impact-driven alpha. I think it's where you go further up the risk spectrum. So, for example, up to public equities, up to more alternative assets, up to on the private side. I think that's where you get more impact-driven alpha because it's easier to kind of select which assets you want exposure to, and it's easier to work in an impact framework and analysis. At least that's what we're seeing in practice. So that's kind of how I would combine those two questions.
Great. And just an additional thought there is, just trying to building off of that, is there's financial alpha from impact and there's impact alpha, which may not be the same thing.
Yep.
Meaning you could have two asset classes that have the same financial performance and one of them is outperforming on impact, which would be very interesting to be able to say, actually, that's our delta as a manager. We can get you that performance, we can get you more impact. So just a thought. Who wants to take any of the others? Sorry, I would have taken better notes if I'd known we were taking 6 questions. What was the impact washing question specifically? Tools to avoid?
Yeah, just sort of developments and tools that help LPs, the underlying
Oh, right, LPs and GPs.
better police the system.
I worry about the word.
Yeah,
Let's
I
not
could
police,
also-
is my guess.
Yeah.
I mean, of course, there's transparency and those sorts of things, but I think one specific way to address concerns about impact washing that we're seeing from investors is to take a more holistic approach to thinking about impact, to think about negative impacts, to think about impact risk, and not just want a prospective fund manager that they're looking at to talk about the positive impacts they expect to have, but to talk about kind of more of a net impact to talk about the risk and the negative impacts, whether it's in the supply chain or to the environment, that things are happening. So I do think one very concrete way investors are approaching this impact washing risk is to take a more holistic approach.
Yeah, I would echo that. I think that's a great point. I mean, I think we recognize that all investments have impact, and we want to think about the positive and the negative, and then in some strategies really aim for specific positive impacts. I'll mention also, it came up in the plenary, I think, the principles for impact management for impact investors that are starting to develop, I think, is a good development because it gives some, common.
Was the IFC ones?
The
or?
IFC driven. They don't want to, I think, brand them as IFC. I don't know. But yeah, the ones that the IFC is kind of has convened a group to weigh in on, and it's a work in progress for sure. And I think that this open comment period everyone should sort of take advantage of. But we need to wrap our minds around, well, what does it look like and how is it different? Because if we are in the circumstance where there are some things that, a portfolio might look very much like another portfolio, so how is it an impact investment portfolio? Well, it could be if there's an engagement approach to change things within those companies, or it could be if, there are certain, if you're achieving different outcomes through a similar portfolio. So how do we create that differentiation? I think these principles are a good step for that, and we'll see. They're new, so I don't know if kind of LPs and clients are yet aware of them and using them, but it could be.
I'll take the liberty of doing the Acumen one. I'll try to be brief. We do private early stage investment in companies that are serving low income customers, historically in the developing world, also in the US. At the highest levels, there's sort of two chapters. Chapter one, up until about 2012, was lots of desk research, lots of making sure the business model made sense, it served the right customers, and there was evidence that there was impact integral. What we found was we weren't really learning in the end. So I guess I would say I feel like we were making the right investments, but we weren't any smarter as a result about where does impact actually get created or not. So we really went back to the drawing board, and we've built now what is we do it for Acumen, and now we're doing it for a bunch of impact investors and others, Gates, OMIDR, DFID, CDC, a bunch of impact funds, we would call a lean data approach to measuring impact, and we survey customers directly over mobile phones. And the idea is simply that if you can go directly to where the impact is meant to be created, it could be customers in our case, it could be the environment in other case, and kind of push yourself beyond, we can't get the data, and actually go and talk to people about their lived experience. We've been very pleasantly surprised by the quality of data we can get and the speed with which we can get it by doing it over mobile. So if you think of inputs, outputs, outcomes, impacts, we had a policy for a decade of basically doing output because that was the best we felt like made sense in our environment, in our context, because an early stage entrepreneur can't afford anything else, frankly. And we're trying to get to self-reported outcomes. And I would say generally we're making a lot of progress. I think our work in this broader context is, well, what does that mean for a public equity strategy? Or what does that mean even for a private equity strategy that is more B2B or larger scale? But I would just say in general, some of it is just significantly just collecting much, much better data. And I do think we're at the beginning of a learning cycle. And I guess that's what I would offer up is ultimately, if you're not using the data you're collecting to get smarter, and if you're just using it to share and to sort of show that you're doing it, I think that you're not going to get anywhere because everyone around you in your firm and your clients are kind of too savvy to let that go forever. And it might be okay for a lot of folks, but I do think there's an opportunity to use it as a learning edge and a differentiator. At least that would be my hope. Okay, and then so we have this two-focused question, and then I think there was let's do the last one, which was, since there's no uniform way, like what specifically are we doing since there's no standard way? I think to report, was that the question specifically?
I'm seeing a combination of both quantitative and qualitative reporting. On the quantitative side, it is, with the exception of Acumen, mostly focused on outputs for the most part. And, I think within the context of a theory of change, I think that's where most investors are today. And then complementing that with qualitative case studies to try to get at the outcomes, but again, it's still not quite there yet. I think that's actually the area that's most exciting around leveraging things like big data, AI, all these terms that you're hearing out there. And we have a big data team that we're partnering with to pressure test some of our ESG ratings methodology, but then also thinking forward as to what are some projects that we can partner with that team around getting creative and maybe taking a lean approach to understanding the outcomes of the investments that we're making. So I think we're still, pretty far away from that point, but I think that's the direction of travel.
That's been exactly our experience as well, a mix of quantitative and qualitative data, and the quantitative data is more output-driven, with a couple exceptions.
Yeah, I would just echo that. I guess I'd add that I do think that the case studies and the qualitative angle is important, as well as we've been talking a lot about the quantitative data, but I think investors really do get a lot out of the case studies and the qualitative data, and that fully mirrors, by the way, what financial reporting for private investments has looked like, through time, where it's a mix, and so that's what we see as well.
I guess, has anybody experienced this sort of, I'll term it as sort of an impact tax, meaning somebody's actually trying to create positive impact, and rather than that being a positive, then there's sort of a not good enough effect. Any thoughts on that occurring? And if so, what do we do about it? It's sort of the flip side of the impact washing, actually, interestingly.
Yeah, in that way, it's kind of a good thing. I think it encourages us to be really careful when we apply the term impact to anything. We kind of know that it's going to get scrutinized more than if we were to call it something else. I won't name the other things, but so it's going to get scrutinized for what is the impact and how are you measuring it, and so I think we just recognize that and sort of welcome it. So before we apply that term, we just make sure that we have some mechanisms in place to be able to demonstrate impact. Yeah.
I think it's also a snapshot of a given point in time and where we are in terms of products and what's available. So for a client that is looking across their entire portfolio, there's plenty of products, I think, in public equities, increasingly more in fixed income, definitely private markets, but in some of those other areas like treasuries, commodities, anything around options, pretty far and few between, which I think that's one of the areas that your client...
Shouldn't that have the opposite effect?
It should, but so I think what I'm saying is the point in time today is that's what's available. Mm-hmm. So, but it's better than nothing, but maybe that's a holdover or a bridge to ultimately when the products can get there. But by having the dialogue that you mentioned of, well, actually our expectations are a lot higher given that you're marketing yourself as impact, and obviously we're understanding around the constraints specific to that asset class. But I think that evolution, today versus where we'll be tomorrow, that conversation needs to happen. But I think it definitely is an opportunity, at least for this point in time, for that to be a bridge until we can get there.
So is the question, you've made an impact investment and then it fails to achieve your full expectations?
No, I mean, I'll wear a slightly different hat. So we're actually, I'm living in the middle of this. So we're actually taking lean data and making it a standalone private company. And so we're in the middle of all the financial analysis that you would normally have, and then really constructive but also very demanding questions around exactly our theory of change, around impact. And it does feel in certain ways like it's a higher bar, right? And it's strange. And so I guess I would, as the person sitting in that seat, would say, what I remind myself is the people asking that question, it might be a type of capital or a quantity of capital or expectations from that capital that would be different, but it can feel like more. It's just like, well, I have to be everything to everybody, and so I think that's the tension of the person. I mean, I'm wondering if I know the company you're talking about. Is it it's C-Note or no? It's called CDC Deposit. Okay, anyhow. No, because I know the founders of C-Note quite well, and I think there's a similar thing where they're just like confused because all of a sudden they're, instead of, wow, this is amazing that you've arrived, it's like this higher, additional level of impact scrutiny, and it does feel kind of paradoxical. Like, well, here's something new, and then, well, it's sort of not good enough. So I guess that's how I would describe it. So there seems like there's a relevant comment or question over here.
Just a question about that larger context for the discussion that we're having here, because it seemed to me part of the problem around a reaction like that to immediate sort of question about impact and suspicion, let's say, it feels to me that while you're solving that internally, there is a larger context in which we need to shift the important impact to anyone in the world, really, with respect to our long-term survivability. Okay. So I guess I sort of wonder the extent to which you all experience this discussion internally as being affected by the much larger conversations going on externally about long-term future, long-term sustainability, not just for this or that business, but for the entire enterprise of the human race. And I just wonder whether you feel that, so if you look at Me Too as an example, I'll just take that one, that's a place where a larger context, well out of control of this discussion, could have a quite material impact on whether gender is relevant to how we proceed as a country or in the world or not. And so I just wonder how much you guys feel elasticity between the larger context and the trouble you have here. I don't think you're going to change the suspicion impact is held in until people see impact as, if not equal to value, then greater than just a normal return because of the longer term implications of this discussion. So I just wonder, do you feel that internal, external, what we would call insider, outsider kind of dynamic in moving this discussion? My experience from a more advocacy side is that the advocates are not too clued in as to this internal conversation.
Well, I think we see the folks who we're talking to and investors having a whole range of motivations for impact investing, and we've talked about some of them on this panel, from maybe more their risk management and some of the public asset strategies to what's motivating a lot of the millennials. Certainly the philanthropic activity they're the kind of issues that you're talking about. Yeah. So there is a group that's really what's most relevant for. There are others that might have different motivations.
You know, there's a thought that you all said impact washing is one like the biggest concern, right? Like really down the road, everyone says that, but it's actually, in a way, I mean, it's clearly an issue. But if the CEOs are standing up and saying we believe in impact, right? People are it's raising awareness. So the long term effect is that people are becoming aware of impact. They're thinking about it, and they're being held accountable over time. And so if they are washing, they'll be you'll find out. So it's just kind of driving overall awareness, which is not.
I'll take the liberty, because we need to close, of responding and closing. I guess what I would say is, if that level of scrutiny were happening to that opportunity as well as to the non-branded impact opportunities, I would feel like it was great. But I think the thing that's odd is you've got a tiny proportion with a paucity of product getting additional scrutiny, and everything else like, oh, that's fine, that's business as usual. So that, I think, is the contradiction. I do agree that it is generally positive and it's becoming more mainstream. But one worries if the tiniest little bit that's already trying to push the envelope is getting kind of beaten down for doing that, and everything else like, well, but that's just business.
Yeah, that was my point initially, and I totally agree. But I was also saying yeah.
Right. Well, thank you all for coming. Thank you all for the great panel. Really appreciate it. And then
thank you, panelists.